Hi, this is Tony Sagami. Hey, were you as unimpressed as I was when you heard that our spendthrift politicians came to an agreement to raise our debt ceiling by only $2.1 trillion? Now, Congress threw us taxpayers a political bone by promising to cut spending. According to the Congressional Budget Office, Congress is promising to cut discretionary spending by a total of $917 billion over the next 10 years. Now, they're also going to create some bipartisan committee, another committee, to come up with an additional $1.2 trillion of tax cuts. Let me tell you, I'm not impressed. You know who else isn't? The Chinese. A Chinese rating agency called the Gong Global Credit Rating immediately downgraded its credit on the U.S. government debt from A+ to single A. To give you some perspective, that puts our country on par with Spain, Estonia, and South Africa. Now, De Gong says that this political escapade isn't going to solve our underlying debt problems or improve our debt-paying ability over the long run. In fact, De Gong says that this new bill will further erode our country's ability to pay back our debt. Listen to this quote. The rise of the U.S. debt ceiling helped temporarily avoid a debt default, but it has not improved its solvency, and the increasing government debt burden will deteriorate U.S. sovereign debt crisis. Yeah, I couldn't agree more. De Gong also warned that our overall national debt is going to exceed our entire GDP by the end of 2013. That's pretty bad when you owe more than you produce in the whole year as a gross. Now, De Gong wasn't the only Chinese agency that's had some harsh words to say about us. The head of China's central bank also had some unflattering things to say about us. Now, he did welcome the headway that we made in raising the debt ceiling, but they also said this, pardon me, China hopes the U.S. administration and Congress would take responsible policy measures to handle its debt issue in light with the interests of the whole world, including those of the United States. And then it also warned that China would seek diversification in the management of reserve assets, strengthen risk management, and minimize the negative impacts of the fluctuations in the international finance market on the Chinese economy. Now, those are some pretty condescending words, and it's really not an insignificant threat that China says are going to diversify out of the U.S. dollar. China is the largest holder of U.S. Treasury debt, with $1.15 trillion. Yep, 1.1 trillion U.S. dollars. But I do find it a little ironic that a communist country is telling America how it should be run. On the other hand, it's not as insulting as you might think, because I almost think that the U.S. and China have changed economic roles in the last decade, whereas the U.S. is becoming more socialist and China is becoming more capitalist. Now, but there is an investment lesson to be learned from this debt ceiling fiasco. And what it is that the U.S. dollar is one of the most dangerous assets you can own today. I'm not just talking about the dollar as a currency, but I'm talking about dollar-denominated assets. I bet you most all your stocks are American stocks that are denominated in dollars, and I bet you the same is true for your bond and bond funds. They're denominated in U.S. dollars, and your 401k, and even real estate for most people is denominated in dollars. Heck, it is for almost all Americans. What I'm suggesting is that you diversify a significant part of your assets out of the U.S. dollar. Now, we all need a place to live, so I'm not saying you should sell your house, but I am suggesting that you should include a heavy dose of foreign stocks and foreign bonds, as well as hard assets like gold and oil and copper in your portfolio. For example, my Asia Stock Alert subscribers own the Merck Hard Currency Fund. The ticker symbol on that is MERKX, MERKX, the Merck Hard Currency Fund. This is a no-load fund that invests in the short AAA government debt of the world's financially strongest countries. So really, it's just a money market fund that's not denominated in dollars. It has very low volatility. But it's done pretty well, too. This year, it's almost up 6% just for the year to date, and it's up over 19% over the last 12 months. So that's a way for you to diversify yourself out of the U.S. dollar. Until next week, this is Tony Sagami signing off.